Hi, I'm James Robinson. I manage money for a living, and this is my stock pick of the week. Today, we're going to look at the dividends for the company Expiditors International of Washington. Dividends are important. Some people buy companies simply because they want the dividend income stream. I think you should look at what's happening with the dividend, what the yield is, how much it's increasing, but you should also look at how safe those dividends are, how sustainable those dividends are, and how likely those dividends are to both increase and to increase at above the rate of inflation. Because if you're going to be a dividend investor, and a lot of people are, you want that company's dividends to grow at least the rate of inflation so that you're getting a raise every year so that you're not becoming poorer every year. So this is a fun chart to look at. This is the dividends for the company and the dividends per share. You can see this company's basically raised their dividends virtually every year since 2000. They've gone from spending about $15 million in dividends to about $175 million in dividends over that period of time. That's obviously a fantastic increase. On dividends per share, it's gone up even faster because they're paying the same amount of money or slightly more money to even less shares as they bought back shares most years. And so the increase has been even more significant. So again, whenever you have a company, whenever you're a dividend investor and you see that every year they seem to be raising their dividends, there's never any steps backwards. That's something that should make a dividend investor very happy. For me, I'm not really a dividend investor. I'm trying to buy companies that increase their value. I don't care if Berkshire Hathaway, like Berkshire Hathaway, they pay no dividends. I'm looking for companies that increase in value. But one of the things that often happens is I'll buy a stock and it takes some time to turn around. And if I can get a dividend return while I'm waiting, so much the better. So having said that, when I look at dividends, I look at them in four factors. I look at what is the yield and the growth of that yield over time, or the growth of how much are those dividends going up over time. I look at dividend safety in the context of the company's earnings. So is the dividend the company is paying appropriate for the amount of earnings the company has? Again, if your dividend is greater than your earnings, over time, you're going to run out of assets to pay the dividend. Something's going to have to give. Nobody likes to buy a stock and have that company cut the dividend, because most of the time when a company cuts its dividend, the share price of the stock decreases more dramatically than the dividend increased, and that's obviously bad juju. I look at dividend safety in the context of cash flow. I do that because earnings don't tell the whole story. Oftentimes things are hidden on a cash flow statement that aren't seen in the income statement. And so looking at dividend safety in the context of cash flow will give you an insight into what's going on there. Finally, I look at dividend safety in the context of the company's current debt load. You have to pay the bank first. You have to pay the bank before you pay the dividends. If you have a tremendous amount of debt, this company doesn't, but if you have a tremendous amount of debt and interest costs go up, which they're doing right now, the dividend expense might eventually gobble up all the money that would be left for dividend payer to be paid in dividends. And so I like to look at this dividend safety in the context of the company's current debt load. So this chart, the blue line is the amount of dividends paid per share over the last 5 years, and you can see that it's gone up every year, even went up during COVID. But having said that, the dividend yield isn't that high. This is as of today. The dividend yield for this company is 1.47%, and that's not very high. The average dividend yield for the S&P 500 today is about 2%. So this company is not paying the kind of dividends that it'll like. Having said that, they are also buying back shares, and they bought back shares at a reasonably good rate. So that's the way they seem to be choosing to return money to the shareholders. But as a dividend investor, I'm not sure I would buy this stock because the dividend probably isn't big enough to make a difference in your savings rate. Also, dividend growth over the last 5 years has only averaged 7.4%. Again, that's not bad in a 3% or no inflationary period, but we're now seeing inflation at 7 or 8%. And so the dividend isn't the reason to buy this stock. It's not bad, and it's not a reason not to buy it. But if I'm a dividend investor, I think I would at this point consider maybe this isn't the right stock for me to buy. Now, as a pure investor, it's very much a stock you should buy. But if you're looking for high dividend yield and dividends that are going to increase at above the rate of inflation, at least based on what this company's done over the last 20 years, it would be very easy to make the argument you should punt. So this slide looks at dividend safety in the context of earnings. So what we're asking is what percentage of the company's profits are they paying out in dividends? And the average, to put it in context, the average payout of the S&P 500 is about 30%. So 30% of the company's earnings are paid out in dividends for the average S&P 500 company. This company over the last 5 years has been 29.2%. So effectively their average. The current payout ratio is 25.6%. So not, again, slightly below what you'd expect, but what it shows is that this management isn't very interested in or concerned about paying us out as shareholders in the form of dividends. Now, they've done other things that make that fine, but if you're a dividend investor, you just have to recognize that this isn't an important thing to the ownership, to the management of this company. And as an owner, you have to decide if that's acceptable because it's unlikely to change. Going over this slide, just so you can get a sense, the green line is the total earnings the company has had over the years. The red line is the percentage of dividends, the amount of dividends that are paid out over that same year. And the blue line is the payout ratio. So that gives you a sense of what's happening with the chart. You see the earnings have gone up nicely every year. The dividends have gone up, kind of marginally every year. And in fact, the payout ratio has decreased dramatically over the last 5 years, which again, further gives evidence to the fact that this company's management isn't super concerned about paying us out as the owners of the company in terms of dividends. That would be more distressing to me if they weren't doing buying back shares as well, which is sort of giving us a double whammy in terms of benefits to the ownership as a result of profits. Before I go any further, I'd like to invite you to follow me on my Twitter account. It's at Robinson Stocks. I put more real-time information on trades. I give you articles and I let you know when I'm posting new videos. If I find an article or something I think is interesting, I'll post it there. So feel free to follow me. I try and keep track of where I know my known followers are. I like to put dots on the map where they are. So wherever you're following me from, wherever in the world, if you've made money on one of my stock picks, just drop me a quick note. Let me know where you live. I'd appreciate it. Also, like every YouTuber, I'm trying to get to 1,000 subscribers because that's where you can start to monetize your account. I'm at 428 now, so love to see you subscribe, hit the notification bell so you can hear about new videos. So on to the rest of the dividends. So the next thing that I like to do is look at dividend safety in the context of cash flow. Now, cash flow is different than earnings because you can't hide as many things there. So first of all, the dividend payout of free cash flow for this company is 28.8%. So it's really sort of in the same line as the cash flow. Also dividend, the average payout over the last 5 years is about 30.3%. So again, in the same, pretty consistent. Just to give you a sense of how this works, the company in 2021 had cash flow from operating activities of $655 million. They spent $47 million in capital expenditures. By the way, one of the things that I look at is what a company's spending on capital expenditures. I like that number to be very low, especially over time, because that means that the company doesn't need a lot of capital to be reinvested to make money. That means the company's free cash flow is $607 million. They paid dividends of $174 million, which is how you get to 28.8%. So again, tons of cash flow to pay the dividend. If the company's cash flow is to be cut in half, they could still continue to pay the dividend without a problem. So that's what we're looking for, and that's why we do this additional level of research. My final slide for dividend safety is I like to look at that in the context of debt. Again, my concern is the company has a ton of debt. If interest rates were to rise, especially if they were to rise dramatically, would the debt service gobble up all the money that's left for investing in the company's, for the company not to invest, but for the company to pay its shareholders in the form of dividends? This company has so little debt and so little interest obligations that it's just not worth talking about. There's no scenario, there's no debt level that's going to really negatively impact this company's ability to pay dividends because they have no debt. So there's no reason to waste much more time on this slide. So the takeaways from this are the company's dividend is solid and it's rising. It's rising at about the rate of inflation historically. The company has plenty of money to pay those dividends. It has plenty of earnings to pay those dividends. If anything, the management could easily be convinced to pay twice as much in dividends, and it wouldn't really hurt the company's ability to service the customers. We're going to show in the next video that the company also buys back shares, and so they're choosing to enrich the shareholders through buying back shares versus just through paying dividends. The dividends for this company are low enough that if I'm purely a dividend investor, this probably isn't a company that I would invest in. But if I'm looking for a great company and the dividends are a bonus, then what the hell, you should buy the stock. So that's basically it for dividends for this company. They're safe, they're solid, but they're nothing to write home about if that's what you're looking for in a stock.